Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night trying to make sense of markets that really don't make much sense. So tonight I want to talk about, will Boeing sink the markets? But before we get there, I want to continue on a couple things I missed from the energy sector outlook video. If you missed that, go back to Monday's video where we spent about 15 minutes on that. I want to look at some charts here and see what you see. So let's go right here to, this is symbol XLE, which is large energy companies. Now just take a look at this chart for a minute. I've got some lines on there, and I want to show you another chart. And here is ExxonMobil. Now, do you notice anything similar? It's because they are almost identical, because XLE, the largest stock in this exchange traded fund, is ExxonMobil at about a little over 20%. The second largest is Chevron at just under 20%, making the two largest holdings. So when you think about, oh, I'm really diversified, I own XLE. 40% of XLE is two stocks. That's not very diversified. So when you look at XLE, you can use them as a proxy for Exxon and Chevron. And what you're looking for here is when XLE eventually breaks roughly $55 a share, it tells you that the party is over. Now, if we go look at ExxonMobil, because again, largest topping pattern in history of probably anything that's been traded in the markets, would suggest that ExxonMobil stock is going to be extremely inexpensive. What it really actually suggests is it doesn't say that ExxonMobil is going out of business or Chevron in the majors. What it says is there's so much debt sitting in oil and gas producing companies, mainly the small ones. There's going to be a lot of defaults. There's going to be a lot of casualties, and it's going to bring the whole market down because there's so much supply. It will turn out to be a great buying opportunity, but you can just see that this big pattern is going to head a lot lower. So from the perspective of ExxonMobil, if we zoom into the one-year chart, you can see right down here it closed today at 67.19. Let's see, after the API report, it's still held steady, but it's sitting right here at 67.19. Now, as we zoom out, you can see 66 is where buyers have been. And if we will zoom back out a little further, and you can see all along here, 66 is where buyers have been. They've been low as roughly 64. But this is a major area of support. If this breaks, it's telling you ExxonMobil is going to lead the entire oil market lower. Great if you're looking to buy in low down the road. Not great if you're a big investor in oil company stocks. Let's take a look at Chevron. You can see it's coiling into this triangle pattern that we looked at. It's looking like it's breaking down and heading lower, and that suggests that Chevron stock will be very inexpensive along with ExxonMobil. Let's take a look at crude oil today, which traded lower, and then after hours after the API report, it's down to 56.35. And so from a charting perspective, let me zoom out just a little bit further. You'll notice I drew this angled purple line up against this rising, you can say it's a rising channel. Now I'll zoom in a little bit. And what you can see is it's confirming this rising channel on the way up, and then it broke this line. So from a technical perspective, the people that were buying here decided they were going to sell. And as this goes down, which is right in here now, the question is, are these people that bought roughly at $56 a barrel, are they still buyers, or are they looking at these inventory reports tonight and then maybe the Department of Energy tomorrow morning, assumingly it's as bad as the APIs, do they become sellers? So what we know is price support for crude is around 52 a barrel. You could broadly paint a brush through here between $50 and $52 a barrel. So what happens is as crude prices fall, prior buyers become sellers, and the question is, where is support? And if support doesn't hold at 52 a barrel, well, your next major support's down here between 42 and 45. So this is very significant. The market has not been pricing in a lot of crude oil inventory builds, but with the coronavirus, you have an issue that could cause people who were going to travel, particularly with Chinese New Year, is a big time for travel, the biggest time for travel in China. This could cause people to cancel their plans, and perhaps people traveling in various parts of the world to cancel their plans. And that would already be bearish on top of the already bearish oil inventory reports. So let's take a look at how that might affect Boeing. Now, Boeing has a massive topping pattern. If we zoom out, you can see this is extremely unusual. This run-up, extremely unusual. But what happens with Boeing during recessions is you can go back to, here's the run up to 2001, and it dropped all the way back to its lows right around $31 to $40 a share. During the next cycle in 2008, it runs up and goes all the way back down to 30 to 35 a share. Here it is, the largest topping pattern in the history of Boeing, which looked like it was going to break in 2016 when it had a topping pattern that shot higher. Could suggest that, could you imagine Boeing being $35 a share again? Now, some people say, well, I'd be a huge buyer in that. You got to remember, if you don't have cash because you're fully invested, you're not really much of a buyer. The question I'm wondering is, does Boeing drag the whole market down with it? Because here's that big topping pattern. And let me zoom in a little bit, see if we can get a better look. You can see support is right between roughly $320 and say $313 a share. Now there is some support down here. And what happened today is people came in and bought this dip. Now why would they do that? Is because they're hoping this is another dip here where this is going to go from roughly $300 a share all the way to $445. That's what they're hoping. The question you should always ask is, who was the buyer here? And most likely this was Boeing who was buying down here because they've purchased $43 billion worth of their shares back rather than investing in making a plane that can fly. So keep that in mind. Boeing is not buying their shares back anymore, which makes you wonder who would come in and provide support here. Is there someone that wants to buy Boeing shares around $300, because that's obviously the price range they are in? If there aren't, what happens is all these people that bought up here, as prices fall, they start to sell. And when you get a whole lot of selling, you get a rapid move down in price. And you see a gap sitting here around 200. And I think there's some other gaps even lower. But what is interesting to me is, will in the next recession Boeing trade all the way back down near its historic lows? I don't know, but it will be very interesting. But from a technical perspective, if you're saying, I don't believe in technical analysis, well, take a look at this. This is none of this here since 2016 is normal market moves. You normally don't see these big run up, and you normally don't see these topping patterns. But what this is suggesting is the big players at Boeing who knew what was really going on have been selling their stock as Boeing has been buying it. And now that the news is finally pointing to this plane is at best not going back in the air for 6 months, maybe longer, maybe never, we don't know. It suggests that Boeing stock has a long ways to fall. So what I want to do is kind of maybe spend the rest of our time here just kind of looking through some charts. Let's get caught up on where Treasury yield's at and maybe some other things have caught my attention. Because mainly the crude oil market is very, very interesting. It may be the leader behind Boeing of what's going to drive the market down. I don't know. But based on the inventory reports, you would believe that. So today, 10-year Treasury yields opened up right in the middle of, or 30-year Treasury yields opened right in the middle of support here between these two purple lines below their 100-day moving average, which now the entire Treasury yield curve is below its 100-day moving average. This is a major area of support because we've seen sellers. Remember, when we look at yield, sellers are on the opposite end of the trade. So normally we would see buyers here, but now these are Treasury bond sellers. So there's a lot of sellers that have been all along in here between these two purple lines. When this breaks, you're likely to see now a run toward the all-time lows, because as all of these sellers get flushed out and become buyers, it changes the momentum and the direction of the market. If we look at 10-year Treasury yields, they closed just below their 100-day moving average, but you see this dotted purple line, this trend line. This is suggesting as yields fall, sellers in here get flushed out, here, down here. It all suggests we're looking at a return on the 10-year Treasury yield to all-time lows. And if it fails to hold there, if we zoom out, and now we'll come back in a little bit. Oops. You see 10-year treasury yields have bottomed at 1.4%, 1, 2, 3 times. There won't be a fourth. At this point, all the people that were selling in here and here that are still holding on to those positions, they will turn into buyers. Yields will tank. That's when I believe the 10-year treasury yield will probably go negative. Now let's go take a look at this from TLT, the largest traded U.S. Treasury bond fund. We see this triangular pattern, and if we zoom out, usually when you have a move up off of a bottoming pattern, and then you run into a triangle pattern, the cayenne lines, it's a continuation pattern. Suggests that this is most likely a continuation pattern. And so far, everything we can see in this charting pattern says bond prices are headed significantly higher. So they crossed out of the triangle pattern. They reconfirmed it, which is quite normal. Now, usually it comes out much sooner, but it came out at the end. And now we're seeing bond prices close over their 100-day moving average, over their 50-day moving average, starting to build some momentum here. And what do you have? You have sellers right in here, sellers here, and sellers here that are starting to get squeezed and pushed out. The big Maginot line is right here around $141 a share. Lots of sellers in here, 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 and over here that as those get flushed out, that just put some rockets under this. Again, what you're looking at in the bond market is telling you the stock market is going to head much lower. And that's how you can interpret that, because when people that are short bonds have to turn around and cover their shorts, they need cash. They need money to either go buy bonds or close their position out. Well, if they're heavily invested in, say, stocks, they've got to sell to get cash to cover their shorts. And that's why when you see these big bull market breakout in stocks, you normally have a very large correction, or at the end of the cycle, like we are now, you can see a bull market breakout in bonds will actually start the bear market and the recession. And this is the biggest biggest continuation pattern in the treasury bond market. You've never seen more money concentrated in bonds in a very few people. As I mentioned to someone earlier today, the one thing I do know is all these computer models, from the quant models, CTA models, to risk parity models, vol control models, algos, all these things are virtually sitting pegged at 100% stock allocation, or very, very close to it. Hedge fund managers are near 100%, large allocations to stocks. What does that tell us? Nobody owns bonds except the large commercial banks and the Fed is chewing these things up like Pac-Man every week, to the tune of $60 billion a month. They're gobbling these things up. And all that says is when the bull market in bonds breaks out, and it will, and investors need to sell stocks to buy bonds, and all of these various computerized programs go from stocks to bonds, there isn't a big supply of bonds out there. And there's going to be a lot of buyers. People say, well, who's going to buy all this debt? Don't worry. Most investors will, and they just don't know it. And what that's going to do is just going to put jet fuel, rocket fuel, right under bond prices and send them straight higher. So with that, we'll wrap up here, and then we'll come back on Friday. Because of the short week, some of the data got pushed into Thursday and Friday that we would normally have today. So we don't have really a whole lot to go on, but if you're wondering what's going on, hopefully now you know. Watch the energy sector for breaks down. So you can look at ExxonMobil stock at $66 a share to start breaking below there. What do we say? Symbol XOP. Watch that at, not XOP, but XLE. Watch them. Oh, you know what we should look at real quick? Let's go look at XOP. This is small oil and gas producing stocks. Look at how this thing ran right into resistance. There's a reason I didn't chase this, but I was watching this and I knew it was going to fail here because of the oversupply. Well, now the people that have been buyers right around $20 per share on this are going to get another chance. And if they're not there, this thing is going maybe, I don't want to say to zero, but it's going to look really close to zero. So watch for XOP breaking around $20 a share. Watch for XLE breaking 56. As far as 30-year treasury yields, watch for a break below 2.2%. 10-year treasury yields, a break below 1.7. So I'm Steve Van Metre. Thanks for watching. We'll see you Friday. The content of this video is provides educational information only. It's not intended to provide investment or other advice. This video is not to be construed as recognition or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that are owned do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.